This series of video lectures will be talking about taxes and subsidies. And let's begin with just some basic facts about taxes and spending. Because again, this is one of those areas where people have a lot of very strongly held opinions, and some of those opinions are based on real facts, and some of them I think are based on myths. So first, let's just look at where the federal government gets its tax revenue. And you can see that by the very largest majority here, three categories make up almost all of federal tax revenue. Individual income tax won't surprise anyone that it is almost half of federal tax revenue. I think a lot of people are surprised that payroll taxes, Social Security tax, Medicare tax, are almost a third of federal revenue. Corporate income taxes are about 12% of federal revenue. And then pretty much everything else out there is pretty small potatoes. And notice something like the estate tax, which people spend a lot of time arguing about, doesn't even merit its own category here. Another thing we might look at is how the federal government's tax revenue has changed over time in relation to the size of the economy. And you can see that it's pretty much always been between 15 and 20% of GDP. It's swung around some. A lot of the swings don't have to do with changes in government policy, but instead have to do with recessions. So for instance, when the economy went into recession in 2008, that caused tax revenue to fall even more rapidly than GDP did. Likewise, when the economy went into recession in the early 2000s, that also caused federal tax revenue to fall. And then typically we see that as the economy begins recovering, tax revenue begins recovering. So all the changes in tax policy that people have spent a lot of time arguing about and a lot of emotional energy arguing about really amount to very small changes in the overall scheme of things. If we look internationally, we would tend to see that the United States is a pretty low tax country. So it may be hard to see in your video here, but the only countries that have lower taxes as a percent of GDP are Chile and Mexico on this chart, and pretty much all of Europe, but also some surprising places, perhaps like South Korea or Canada or Israel are also much higher tax places than the United States. Interestingly, from the sort of viewpoint of the person who made this slide, who was sort of writing on a left-of-center blog, they sort of pick out the U.S. corporate income taxes as one of the key main things that is causing the U.S. to have a low tax as a percent of GDP. And their implication was that the U.S. is a real outlier here in terms of having a low percentage of corporate income tax relative to GDP. But when you delve into that a little bit more, the reason for that is actually kind of surprising. So what has happened is that although the U.S. corporate income tax rates are lower than they used to be, substantially lower, come down from about 50% down to the upper 30s, other countries have actually cut their corporate income tax rates even more rapidly. So countries like France or Germany or Sweden have often cut their corporate income tax rates, and many now feature corporate income tax rates that are lower than the U.S. So even though these countries have a reputation of sort of being social democratic or socialistic from the United States' point of view, they actually charge fairly low corporate income tax rates. So even though the United States is having a high corporate income tax rate, the bracket is high, it doesn't collect that much in corporate income taxes relative to GDP, which is sort of mysterious. Now, some of this is because of differences in the amount of loopholes or deductions or something like that. But there's actually a secondary issue. So you may have heard in the news that corporations have considerable latitude using different forms of accounting to figure out which country they want to declare their earnings in. And of course, there's an enormous incentive to declare your earnings in the country with the lowest tax rate. So, when the U.S. has a relatively high corporate tax rate, countries are not going to declare as much profit in the U.S. as they might if the U.S. had a corporate tax rate that was more comparable to other countries. And sort of, economists love to identify kind of a free lunch scenario where we can improve efficiency without actually making anyone worse off. And we want to think about what goes on in the United States with corporate income tax and dividend taxes. So right now, suppose a company earns $100 worth of corporate profits, and it's going to pay that out as revenue, as dividends. So of course, it pays corporate income tax on that $100. So pays $35, say, if we have a 35% tax rate. Pays $35 in corporate income tax, leaving it with $65 of after-tax profits. Of that, when it pays it out to its shareholders, they pay 15% on the dividends, because dividends are taxed at 15% in the United States. So when that $65 is paid out as dividends to the shareholders, they pay $9.75 in tax on the dividends, and they're left with $55.25 after taxes. So of that $100, $55.25 actually gets to the shareholder, and then $44.75 ends up as tax revenue. Now let's suppose that we were going to switch these two tax rates. So we're going to change the corporate income tax rate to 15% and the dividend tax rate to 35%, which would make it comparable to the tax rate on ordinary income for someone in the upper income tax bracket. So we'd be cutting corporate income taxes, but raising personal income taxes. Well, if we do that, then corporations are going to have an increased incentive to actually declare their income in the U.S. because that 15% would be actually significantly below the tax rates in most other fully developed countries. OECD here is the Organization for Economic Cooperation and Development, which is sort of a club of the other wealthy countries out there in the world. So, if the U.S. is now the relatively low tax place in the world, corporations are now going to declare some of their taxes, some of their income in the U.S. so that they can take advantage of that 15% tax rate. So the reported level of corporate profits in the U.S. is going to go up. And when that happens, if you go through all these calculations here, you're going to see that this is actually both going to produce a higher income to the shareholders and a higher level of tax revenue. Because although the shareholders are paying more tax on any dividends they receive, they're also going to receive more dividends because fewer of them are taxed away up at this point here. And this is sort of one of those things that may not be super politically viable because everyone thinks, well, we can tax corporations and that doesn't actually affect anyone, but when we tax investors, maybe that affects their savings behavior. But from the point of view of an economist, really the important thing is these two combined tax rates. And we can change this one, the tax rate on corporations, and adjust this one in the opposite direction and maybe make some useful progress. What about spending? What does the federal government spend its money on? Broadly speaking, three big things, and those are Social Security, defense, and health care. There's also some more general safety net programs, unemployment insurance, and that kind of stuff, interest on the debt. But you can see if you take all of these categories right here, that's the vast lion's share of federal government spending. Everything else the federal government does is pretty small potatoes. And so if you're going to get serious about controlling federal government spending, if that's the way you want to tackle the federal government's deficit, then you're pretty much going to have to go after some of these big categories here. What has happened with federal government spending over time? Unlike the federal government's tax revenue, which has been more or less stable over time, federal government spending has pretty clearly trended upward over time. And remember that now for the last 20, 30, 40 years, we've typically had tax revenue be between 15 and 20% of GDP, and that was probably sustainable for a long time. But for the last, since the sort of early 80s or something like that, we've pretty routinely had federal spending be over 20% of GDP. And, I think there's good arguments that people can have over should we have taxes and spending be relatively modest at, say, 15% of GDP, or should they be higher with taxes and spending up at 25% of GDP. But you just can't go along having tax revenue be, say, 16 or 17% of GDP and spending up here at 23% of GDP. You just can't persistently run those large deficits. So you're going to have to find some way to bring spending and tax revenues into balance. So why has spending inched upwards over time? One thing you might think about is defense spending. Defense spending is actually kind of on a long downward trend over time as a percentage of GDP. In absolute terms, of course, it's going up because the overall economy is growing, but looking at how much of our economy we devote to defense spending, it's going down over time. And you can see that there are periodic up blips here that are related to wars. So this is the Korean War here, this is the Vietnam War here, this is the defense buildup at the end of the Cold War during the 1980s, and here, this blip up here is everything related to Iraq and Afghanistan and so on and so forth. So I think this is sort of one of these things. This is, 3 or 4% of GDP, 5% of GDP, that's a serious amount of money. But if we're trying to explain what's going on with the federal government's finances, it's pretty hard to blame it on, increased defense spending, because defense spending over time is, again, trending downwards as a percent of GDP. Essentially, almost all the growth in federal government spending comes as a matter of these three categories here. So Social Security, not surprisingly, of course, people are living longer, so Social Security spending is getting to be a larger percent of GDP. Medicare is also going up pretty significantly, and other healthcare programs. These are the two big cost drivers, because you can see that Social Security is, although it's a high percent, it's not quite growing as fast, whereas Medicare has really trended up. If we looked at the difference here between the beginning where it's less than 1% and where it's projected to be by 2021, it's quadrupled. And these other healthcare programs have also something like quadrupled. So this is where almost all the growth in federal government spending comes in, through Social Security, Medicare, and other forms of health care. And probably any reasonable approach to the federal government's budget problems is both going to have to worry about getting a matchup between the overall level of federal spending and federal revenue, and also doing something to contain the long-run growth of these costs related to Social Security and health care. There are fewer nice pie charts available on the California government, but I think it's also useful to know what does California spend its money on. And broadly speaking, the big categories are education for kids and healthcare, and that's mainly Medi-Cal. So while the federal government mainly takes care of old people and national defense, the state governments mainly take care of young people and poor people, because essentially K through 12, of course, is young people. Medi-Cal are people who don't have a lot of money, and there's also a fairly big chunk in here for the effects of poverty related to corrections, say for instance. So essentially that's what the California state government does. The big things are education, either K through 12 or at the higher levels. Higher education, 7% here. So education all told is 35%. Healthcare is another 30%. So that's almost 2/3 of the California state budget is basically being spent on education and healthcare. And then everything else sort of rounds it out here. I think there's an idea that somehow either at the federal level or at the state level, there are somehow these massive armies of bureaucrats who are the main thing that we spend a lot of money on, but really that's not so much the case. If we go back to the federal spending again, big chunks here are Social Security. That doesn't really involve that many personnel. Defense, well, that may involve some bureaucrats, but also just involves buying a lot of weapons and paying a lot of soldiers. Medicare, well, that involves paying for real services, real medical services. And likewise, unemployment insurance, although there are some people involved in writing the checks, most of the money is actually for the checks itself. So I think the idea that there's these big pools of waste and fraud and sort of people sitting around doing nothing is just not consistent with the reality.